It's impossible to try to time the market, and if you do try to time the market, it's like trying to catch a falling knife. Then you can take this $1 million property, sell it, and you can use your profits to go out and buy a $2 million property, and you can do that again and again and again. So they're going to kick Tesla out, and they're going to put in whatever the new company is. What's up, everybody? I am Jaspreet Singh from theMinorityMindset.com, where money minds rethink rich. Investing is the real secret to building wealth. Now the question is, how do you invest your money, and where do you invest your money? That way you can build this wealth over your lifetime. Well, in this video, I'll put together some of our best clips where I go over some of the different investments that you want to own for life and how to actually invest your money. So let's get right into it. When you spend money most of the time, you are a consumer. Like if you go out to McDonald's and you buy a burger and you buy some fries and you eat it, you are consuming their products. When you invest your money, you become a producer. Now instead of you being the person that's buying the burgers, you're the one that's selling the burgers. Speaking of McDonald's, one way to do that is by actually investing in and buying one of the McDonald's franchises. Now you own a McDonald's store, so if people are buying McDonald's sandwiches from you, you're the one making money. The other way you can do that is by investing in the McDonald's corporation, the actual stock. If you go onto the stock market and you buy one share of McDonald's, you become one of the owners of McDonald's. Now, if you just own one share of McDonald's, you're not going to get to tell them what to do and how to run their business, but you do get to share in the profits when McDonald's makes money. Now, the difference between being a real investor and being a flipper or a trader is how long you plan on owning your investment for. Like if you stick with McDonald's, if you plan on just buying and selling their stock in 3 months to make a quick profit, you're not an investor, you're a trader. If you plan on owning this investment for longer than a year, now you're classified as an investor. So if we draw this out, when you invest your money, you're using your money to be a producer, not just a consumer. Remember, when you're a consumer, you're just eating the product or using the product. When you're the producer, you're the one that's making money off of the product. So you're investing in being a producer, and when you invest your money, you have a time span of having your money invested for at least 1 year. What I want to talk about in this video is not just your regular investments. I want to talk about the investments you should be holding for your entire life because they're a little bit different than what you might think. I'm going to be going over 5 different investment types in this video, so make sure you watch this video until the end. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. The first is real estate for residential purposes for reasons that you might not expect. Now, when I say real estate for residential purposes, I mean real estate where people live in. So this can be homes or apartments. I'm not calling it residential real estate because when people say residential real estate, that typically means we're talking about single family homes or small multi-family units up to 4 different units. When I say real estate for residential purposes, this can mean single family homes, or this can mean big apartment complexes where people live in. The way real estate investing works is like this. Let's say you find this house right here on sale for $100,000, and you go through the property and you think it's a good property in a good area. So then you come in, so I'm gonna draw you right here, and I'm gonna draw you with a nice mustache, of course. You come in and you buy this property for $100,000. Now you own this home right here, but you're not gonna live in this home yourself. Instead, what you do is you are going to lease this home out to this person right here and maybe their family, and they're going to live in your property, but in exchange of this person living in your property, they're going to pay you $1,000 a month in rent every single month for them living in your property. Now, you can continue working your job like normal, or you can go on vacation or do whatever you got to do, and you will continue making this $1,000 a month every single month because this person needs a place to live, and where they're living, they're living in your home. The reason I say you want to own real estate for residential purposes for life is because people will always need a place to stay no matter what happens in technology and no matter what happens in the future. People will always need a home. You can compare that to the past, where people used to look at shopping malls and strip plazas as the thing to own in real estate. Well, as technology came and Amazon came and the shopping dynamic of the world changed, then shopping malls didn't become as attractive. There were people who made a ton of money in the strip mall and the shopping mall business. But now that industry is kind of dying because the whole shopping industry is changing. Same with office real estate. Real estate investors back in the day used to say that companies will always need a place to work. But then came the 2020 pandemic, and then people realized that they can work from home, which made office real estate not so attractive. Residential real estate is a little bit different because people will always need a roof over their heads. People will always need a bed to sleep on, and people will always need a home to stay in. That makes it a lot easier for you to own real estate for the rest of your life, because the only reason people won't want a home to live in is if people decide that they're more comfortable living on the streets. Now let's talk about why you don't want to own real estate for the rest of your life. So for the sake of this example, let's say over here you have a single family home and here you have an apartment complex, both of which you can buy for $1 million. And let's assume for the sake of this example that if you rented out both of these properties, after paying all of your expenses, you would be left with $70,000 at the end of a year. So you buy each one of these, and each one of these make you, let's just say, $200,000 a year in rental income, and then you pay for all of your expenses, your property taxes, your insurance, your maintenance, your management fees. After paying all of your expenses, you are left with $70,000 worth of profit, and we're assuming that there's no debt. You're buying these properties with cash only. That means both of these properties are paying you a 7% annual return, because here you're buying this house for $1 million and you're making $70,000 a year in rental income profits, and here you're buying this apartment complex for $1 million and you're making $70,000 a year in profits. But you also have to remember that just because you made $70,000 doesn't mean you get to keep $70,000, because the IRS wants their cut. You gotta pay taxes on this money. However, real estate does come with some legal tax loopholes. When you own real estate as an investment, meaning you're not the one living here, you are renting out your property to somebody else, then you get to tell the IRS, hey, this property that I own is 1 year older, so I deserve a tax break called the depreciation deduction on my taxes. And so you get to take a tax break on both of this income right here because you own investment real estate. But the size of your deduction is going to be different here and here, because this single family home is considered residential real estate and this apartment complex is considered commercial real estate. Residential real estate, so single family homes, 2 families, 3 families, and 4 family units, let you depreciate your property for 27.5 years, while commercial real estate, so anything over 4 units, lets you depreciate this property over 39 years. I'm gonna explain what this means. So now what you're gonna do is you are gonna take the value of this building, not the land, the building itself, and divide it by the number of years that you can depreciate it on your taxes. So for the sake of these examples, let's assume that when you buy this $1 million property, $200,000 of which is going towards the land value, because you know these properties sit on some land, and $800,000 is for the building. So you're paying $200,000 for the land that this property's on, and $800,000 is for the actual building. Once you know that, now you can do $800,000 divided by 27.5, which is, one second, $800,000 divided by 27.5, $29,000. So over here you get a $29,000 tax break every year for 27.5 years. And over here, $800,000 divided by 39, this is about $20,000. So here you get a $20,000 tax break every single year for 39 years. What this allows you to do now is you buy this property, you make $70,000 a year, but you only pay taxes on $79,000 minus $29,000, so right around $41,000. You're only paying taxes on $41,000 worth of income for the first 27.5 years. After 27.5 years, you don't get this deduction anymore. Same thing here. Here, you make $70,000, but you only tell the IRS that you made $50,000, and you get to do that for 39 years. After 39 years, you don't get that deduction anymore, which is why a lot of people invest in real estate, but they have the goal of never holding it longer than 27.5 or longer than 39 years. However, you also get some benefits if you own real estate for your entire life. So this is the reason why you wouldn't want to own real estate for your entire life, because after 27.5 years or after 39 years, you no longer get this tax break, and so now you have to pay more money in taxes. And so if you don't want to pay more money in taxes, you might want to sell your property after 27.5 years or after 39 years. That way you can take advantage of all these real estate tax breaks. However, let's go over why you might want to own real estate for your entire life. So now, same example. You buy either one of these properties for $1 million and you own it for some time and you're making rental money every single year. But now a few years go by and you find out that your property is now worth $5 million. So you got a lot of equity in this property because you bought it for $1 million and now it's worth $5 million. And now you're thinking, yeah, I want to give this property or this money to my kids. Now, one thing that you can do is you can sell this property and get $5 million worth of cash, but now you have millions of dollars worth of profit because you bought this property for $1 million and you're selling it for $5 million. So you're gonna have a pretty big tax bill where you're gonna have to give a big chunk of this money to the IRS in taxes. The alternative, assuming you do not sell this property for cash when you're alive and you own these properties, either one, until you die. Now, when you die, your estate gives this property, either one, to your heirs, your kids. Now what happens is your kid is gonna get this property and the government is going to say that your kid got the property, they bought it for $5 million. So if your kid went out and they sold this property today for $5 million after you die, they will get this $5 million of cash and they don't have to pay any taxes on this money because to the government, it looks like they bought the property for $5 million. This concept is called stepped up basis, and essentially what it's saying is if you die with this property, then the person you give this property to essentially can say that they bought the property for how much it's worth when you die. So now if you get here, you don't have to worry about selling your property for a profit and then paying taxes and then giving this cash to your kid. What you can do is let this property live with you for the rest of your life, and then when you die, you give this property to your kid, and now what you have to worry about is estate taxes, but you get a much bigger kind of cushion with estate taxes because you have to be gifting millions of dollars before any estate taxes come into play. Now I do gotta let you know, although I am an attorney, I'm not your attorney, so if you have specific tax questions or legal questions, talk to a professional in your area. The last reason why I say real estate is an investment that you want to own for your entire life is because with real estate, you own something tangible that you can see, feel, and touch, and this is something that can continue to provide you income and income growth for the rest of your life, because if there's demand for this property wherever it is, then what you're going to see happen is more people are going to want to live there, which means the rent that you charge can go up too. So now as things become more expensive because of inflation, the amount of money you make every single year also increases because there's more demand to live in the property that you own. Second thing you want to own for life is the stock market in general. And when I say the stock market in general, I don't mean investing in stocks the way most people talk about investing in stocks. I talk a lot about investing on a YouTube channel, from real estate investing to stock market investing, which is why if you haven't subscribed to our channel yet, you should do that. But when most people talk about stock market investing, they're trying to find the next hot stock. How can you find the next Tesla or the next Amazon or the next Apple before it makes it big? Now, you can make a lot of money if you find the next hot stock, but that might not be something you want to own for the rest of your life because, well, Tesla could fail, Amazon could go bankrupt, and people might stop liking iPhones. Now, I know what you're probably thinking. Oh, just but Amazon can't ever fail. They're a powerhouse. How could anything be bigger than Amazon? Well, that's exactly what people used to think about Sears. Sears used to be the monster retailer, and back in the day, people used to think that there would never be a Sears competitor because they were so huge. Well, now times have changed, technology has changed, and Sears is bankrupt. Companies will change, technology will change, people will change, but one thing, if you believe in the United States and if you believe in the American economy, one thing that won't change is the economy. So if you believe in the American economy, what you want to be betting on is the American economy, because while companies like Sears might come and fail, and JCPenney might come and fail, and Circuit City might come and fail, and Hertz might come and fail, and California Pizza Kitchen might come and fail, the American economy has continued to grow. The closest way for you to get actual exposure to the American economy is to invest in the broader stock market as a whole, and that would be through funds like VOO and SPY. These are two different ETFs, exchange traded funds, which allow you to invest in the broader stock market because both of these funds give you exposure to the top 500 companies in the United States. So both of these funds give you exposure to the S&P 500. Now I want to give you a little caveat here because the United States economy and the stock market are similar but two different things. The economy is the economy. This is our companies, and this is how many people have jobs, and this is how well our economy is doing. The stock market is where people bet their money based off of how well they think the economy is doing. So while they're similar, they are different because when people put their money in the stock market, they're betting that the economy is going to do well in the future. The way you invest in these funds is the same way you invest in any other company. You just go into your stock brokerage and then buy these funds as opposed to buying something like Tesla or Amazon. Now, I should also remind you that when you invest your money, you are never guaranteed to make money. You might even lose money when you invest, which is why you should always do your own due diligence diligence and never blindly listen to a random guy on YouTube. But when you invest in funds like these, now what you're doing is you are essentially betting on the growth of the American economy. You're not trying to get rich overnight. You are just betting on the slow and steady growth of the economy. If the economy is growing and our companies are growing and companies are making more money, well then chances are these funds are going to continue to make you more money too. By the way, if you do want to learn more about how to actually invest your money in the stock market and grow your money and find a good stock brokerage to use, our team put together a very comprehensive article that goes over all of that, and you can read it on our website, theminoritymindset.com, and I'll also link it for you in the description below. The advantage with owning something like this for the rest of your life is now you don't got to worry about changing trends, because like I said before, companies will change, people will change, and technology will change, but the economy will continue to grow. So as companies come and go, these funds will kick out the companies that are not doing too good, and they will add in the companies that are doing better. So if a company is no longer one of the top 500 companies, it will get kicked out of these funds, and then these funds will add in a new company who is now one of the top 500 companies. Now the difference between owning something like this and owning real estate is with real estate, typically you're investing in real estate for passive income. So you're going to make your investing decisions based off of how much money you're making every single month. Here, you do get some passive income from dividends, but it's not going to be as much as the amount of passive income you're getting from real estate. However, you do get the stepped up basis here like you did in real estate. So if you invest $1 million here and over your lifetime this goes up to $5 million, well, you could sell your investment and pay taxes and then give this money to whoever you want to give it to, or you can own these investments for the rest of your life, and if you don't have to use this money and you die with these assets, well now they can go to your kids or whoever you want it to go to, and they will own these assets, and when they sell it, if they sell it for $5 million, which is how much it's worth when you die, they won't have to pay any capital gains taxes on that. The third thing you want to own for life is gold with an asterisk, because this should be a small part of your portfolio, no more than 5 to 10% of your entire portfolio, because gold is not there to make you wealthy. It is there to protect you against a worst case scenario type of situation. Your stocks and your real estate are what you own to fund your retirement, to create more passive income, and to build your wealth. Your gold is almost like financial insurance. It's there to protect you against something horrible happening in the economy. There's a few different ways that you can invest in gold. You can invest in companies that mine in gold. Now you're not actually investing in gold, you're investing in companies that mine in gold, and as gold prices go up, these companies make more money because there's more of a demand for gold. Or the second thing you can do is invest in gold certificates. So now you're investing almost like gold stocks. You're investing in a fund that gives you exposure to actual gold. So a company owns physical gold, and now you're investing in a fund that this company created, which gives you exposure to their actual gold. So it's a little bit of a derivative, but it gives you exposure to physical gold. And the third thing that you can do is invest in physical gold bars. So if we're talking about owning gold, the ideal thing to do is own the physical gold bars, because that gives you the most insurance, because this is something you can see, feel, and touch, and it's something that you can control. Again, this should not be a huge part of your portfolio, and this should not be something you're stressing about. And if you don't have any other investments, you should not be worried about buying gold right now. The first thing you need to be worried about is buying the real estate, buying the stocks, buying the things that are actually going to make you money. Once you establish yourself, and once you have some real financial assets, that's when you can think about adding some gold, remember asterisk, adding some gold to your portfolio. Gold comes in handy in worst case scenario type of situations. So when we talked about investing in stocks, we're betting on the American economy, because if the economy continues to grow, well then the stock market is going to grow. But if the economy completely fails and our dollar becomes worthless and people have no money, well this is where gold could have value. Gold is the original currency, and a lot of people believe that if the dollar were to fail, then people would revert back to gold. If you remember back during the Great Depression, there were countries in the world that saw hyperinflation, where people would have to take literally a wheelbarrow full of cash in order to afford a loaf of bread, because then gold became so expensive. And so the thought is, if the worst case scenario type of situation happened and the economy crashes and the dollar goes to nothing, well then people will go back to things like gold, because this is a tangible currency and this was the original currency. You know, people have been betting on a doomsday situation like that for decades and decades and decades, and to date they've been wrong every single time. Which is why you want to make sure you're investing in your wealth first, but you always want to protect yourself, because yeah, there's a chance that things could go really bad, which is why you want to own some gold. Going along with that, the fourth thing you want to consider owning for the rest of your life is some cryptocurrency. So this is what's considered the new digital gold. Gold was the original currency, and many people believe that cryptocurrency and blockchain will be involved in our future currency. Now look, there's a lot of speculation around cryptocurrency, and there's a lot of guessing around what cryptocurrency will be in the future, and nobody can predict the future, which is why, again, we got this asterisk here, because this needs to be a small percentage of your portfolio, okay? This is not something you want to bet your entire life savings on. This is something where you want to put some money, because there's a lot of potential with cryptocurrency and there's a lot of potential with blockchain. However, there's a lot of uncertainty around it. Again, this should not be your first investment. Get the things that are proven first out of the way. Own your stocks, own your real estate, own the things that are going to make you wealthy and pay you with passive income. Then once you do that, you can put some money here. And fifth, the last investment we're talking about that you want to own for life are commodities that you need to survive. So one way to kind of think about this is you might have heard examples of super wealthy people and rich people that have these bunkers in their homes that protect them against any nuclear blasts. And inside of these bunkers, they have food and rations that will survive them for years. Now, I'm not saying you need to spend $1 million building an underground bunker below your home, but you should consider investing in some commodities that people will need to survive. So one example of this is water. If you've ever seen the movie The Big Short, great movie by the way, which talks about the 2008 real estate collapse, at the end of the movie, they talked about how this guy was investing in water because we have a limited supply of water in the world and our demand and our needs for water keep going up. We need water in order to survive. It's a commodity to survive. And so this is not something that's going to make you rich overnight. But if the demand and the need for water go up and our supply of water is limited, well, this could create a real problem in the future. And so you want to be kind of a proactive thinker and start thinking about things on how to take care of yourself and your finances in this case. And one way that you can get exposure to that is by investing in, again, companies that clean or store water, or investing in water ETFs that give you exposure to the water commodity. Another thing that you can potentially consider is, okay, investing in a farm, an actual farm for your family, just in case, because we never know what's going to happen in the future. I mean, we have a lot of tension in the world, and let's say things go bad. If you have a farm, well, now you can kind of be self-sufficient. You can grow your own food and have things to take care of yourself and take care of your family. Again, this is a commodity to survive. Is this something that's going to make you rich overnight? No, but you're protecting yourself against anything. Before we get into the next clip, I do want to let you know that if you are interested in learning more about money management and investing, our team has put together an amazing guide that walks you through financial education, that way you understand how to use your money, how to manage your money, and how to invest your money the right way. This guide is completely free when you sign up for our newsletter, and it will walk you through the things you need to understand about financial education and managing your money and investing your money the right way. So if you want to download our free guide and get a free newsletters, I got the link to how you can download our guide in the description below. When I invest my money, there's two things that I always look for. I look at how much risk is involved, and I look at how much money I can potentially make. If I was gonna invest $10,000 and I had to decide between investing this $10,000 into my broke cousin Bunty, who's on his 34th business idea, or investing this money into Amazon, who's established and has a business plan and is very successful, I'm gonna expect very different returns to justify my investment. Bunty is a risky investment, so I'm gonna need bigger potential returns to justify me giving him my cash, because as soon as I give him that $10,000, there's a good chance that he's gonna invest that money into a new Gucci wardrobe. I gotta look good for the business. Deciding between investing your money in my cousin Bunty or Amazon is pretty obvious. I'm gonna invest my money in Bunty. But what if you had to decide between investing your money between Amazon and Apple and FedEx and Verizon and McDonald's and Microsoft? Who's gonna give you the best return for your risk now? Not so easy anymore. There's three different ways that you can take this. Option one is you can spend all the time researching these companies, and you might decide that Apple is the best company to invest in based off of all your research, and now you invest all your money into Apple. This one has the most risk because now if Apple releases a really bad iPhone and people start hating Apple products and their company tanks, well, down with it goes your money. It also comes with the most upside because now if you're right and Amazon wins big, then you're gonna win big. Option two is now you can open up a stock brokerage, and instead of just investing in one company like Apple, you can invest in every one of these companies. That way you're lowering your risk. If you do want to learn more about how to actually open up a stock brokerage and invest your money in stocks, our team wrote an article on our website, theminoritymindset.com, that walks you through how to do that. So if you want to read that article, I'll link it for you in the description below. This one requires more work because now you're not just managing and monitoring one stock stock, you gotta manage and monitor a whole portfolio of your stocks. Or option 3 is you can pay a small fee and then you can invest in a fund like a mutual fund or an index fund or an ETF and let these funds invest in all these companies for you. So now instead of you going out and investing in all these companies, you invest in a fund that gives you exposure to all these companies. Well, all 3 of these funds give you exposure to the stock market. They work in very different ways which can affect how much money you make, which is why you want to understand the differences. And that's what I'm going to be going over in this video as soon as you fund that thumbs up button below. Let's start with mutual funds. Mutual funds are known as actively managed funds. And to understand how they work, let's assume for the sake of this example that this is a mutual fund that's made up of only 4 stocks. A lot of times mutual funds will have way more stocks, sometimes hundreds of stocks, but just to keep things simple, we're going to assume that this mutual fund only has 4 stocks. If you wanted to invest in McDonald's, Tesla, Apple, and Amazon, one thing that you could do is you could go out, open a stock brokerage, and individually invest in McDonald's, Tesla, Apple, and Amazon. But now you have to decide how much of your money are you going to allocate towards each stock and what stocks do you want to own. On the flip side, when you invest in a mutual fund, you have this person right here. We're going to call this person a money manager, and we're going to draw him a nice mustache. This money manager is who you're trusting. So you're going to give your money to this money manager, and this money manager is going to create this fund. So this person is managing this fund, and when this money manager likes a stock, they're going to buy it. When they don't like a stock, they will sell it. So maybe right now this money manager likes these 4 stocks, but some time goes by and he's like, you know what? I don't like McDonald's anymore. We're going to replace them with Chipotle. So now he's monitoring the stocks and he's actively buying and selling based off of what he thinks is going on in the market and based off of what he thinks is going to make this fund more money. The whole point of a mutual fund is to have a really smart money manager with the goal of this money manager being able to beat the general stock market. So you are hoping that by paying this money manager a fee, you are going to be able to outperform the stock market, which in turn will make you more money. You're also getting the benefit of passiveness because now you're not having to go out and individually invest in all of these companies and manage each one of these companies. You have a money manager who's going to do that, and you also have the benefit of diversity because now this money manager is diversifying your money into different companies. If you want to invest your money into a mutual fund like this, you can expect this to cost you something like 2% a year on all of your assets. What that means is if you deposit $100 into your mutual fund, this money manager is going to take $2 a year to manage your $100. So if you invest $1,000, that's $20 in fees, and if you invest $100,000, that's $2,000 a year in fees. Now, while 2% might not sound like a lot of money, it does add up, especially as your money grows and compounds. Like if you started investing $500 a month today and you were paying 2% a year in fees, and you were able to get an average 7% return on your money, over the next 30 years, you're going to end up paying something like $166,000 in fees to your money manager just to invest your money. Now, look, I'm a value person. If you can make me an extra $1,000, I will gladly pay you an extra 2% in fees. So if you can make me more money, I will pay you more money as long as I continue to come on top. The only issue with this is what we've seen over the long term is these mutual funds don't always outperform the market. Actually, a lot of mutual funds can't even meet the returns of the general stock market over the long term. Like Warren Buffett was so confident in this that he made a $1 million bet that the general stock market, the S&P 500, would be able to outperform a number of hedge funds. These are highly sophisticated, highly expensive hedge funds. And over a course of 10 years, the hedge funds did well, but they did not even meet the stock market returns. So then the hedge fund owner had to then pay Warren Buffett $1 million because he lost the bet, and Warren Buffett took that $1 million and he donated it to charity. I'm gonna go over how you can get the general returns of the stock market without paying these high fees, but in general, a mutual fund's goal is to be able to beat the market. That's why you're paying these fees to a money manager. That way you have somebody who can hopefully beat the market. The only problem with that is a lot of times you will not beat the market. Sometimes you will, sometimes you won't. It's really hard to predict because it's hard to beat the market, especially over the long term. This is not to say that mutual funds are never the right answer. I mean, there are some really good mutual funds out there, but a lot of these really good mutual funds are reserved for super high net worth people. Like you need at least $500,000 to get into some of these mutual funds versus some of the regular mutual funds that you're just paying 2% on. You could get a better return without paying all the fees. Second, let's talk about index funds. So the whole idea of index funds came about by this company called Vanguard, and Vanguard said, you know, what if we could let people invest in a group of funds like this without paying these super high fees? Well, The only issue with that is you need to pay this money to a money manager. So if Vanguard wanted to create this index fund where you can invest in a fund without paying all these fees, they also had to get rid of this person with a mustache right here. And instead what they did was they replaced that person with a mustache with a computer who automates this investments. Now you're investing in a fund, a group of companies, but instead of having a money manager decide which companies are in this fund, you're going to have a computer decide. So you create an algorithm. What are the type of companies you want to invest in? You punch that into the computer, and then the computer decides what company fits that fund. For example, I just talked about investing in a fund that gives you exposure to the S&P 500. The S&P 500 is an index, meaning it's a group of stocks that gives you exposure to the top 500 companies in the stock market. Now, one thing you can do is go out and individually invest in all 500 of these companies, but that's going to take a lot of work and a lot of management headache. Or you can invest in an index fund that gives you exposure to all 500 of these companies. That's what Vanguard allowed you to do. Now you can just invest in this index fund, and that gives you exposure to these top 500 companies. So now you're getting exposure to the general stock market without paying all the fees. VFIAX is the Vanguard index fund that gives you exposure to the general stock market. So Vanguard is the company that created this index fund. There's a bunch of banks and a bunch of companies that create these type of things. Vanguard is just one of those companies. It was the first to create index fund. So Vanguard has this index fund, which is a group of stocks that gives you exposure to the top 500 companies. If you want to know how much fees these index funds cost, all you got to do is search it on Google. So like with this VFIAX, you can see it says in the title that this is the Vanguard 500 Index Fund Admiral Shares. It has the word index fund in the title, so you know it's an index fund. And over here, you can see something called the expense ratio. This expense ratio is how much money you're going to be paying in fees. That's what you want to pay attention to. 0.04% in fees means that for every $100 you invest, you're going to be paying 4 pennies in fees. Compare that to the 2% fee you'd have to pay with a mutual fund where you're paying $2 out of every $100 you invest. So the fees with an index fund are way less because now you substituted that money manager with a computer, and computers are a lot cheaper to maintain than people, especially if they have a mustache. What you have to understand about index funds is a lot of them have a minimum investment. Like this Vanguard index fund has a minimum investment of $3,000. So if you don't have $3,000 to invest, you cannot invest in this index fund, and you also can't just buy and sell this index fund whenever you like. Index funds like VFIAX only let you buy and sell this index once a day. So if you're trying to trade index funds and mutual funds, that's not the way to go because you can't just buy and sell an index fund whenever you want. You can only do that one time in the day, and typically it happens at 4 p.m. as soon as the market closes. But if you're looking to be a long-term investor, it really shouldn't matter too much because now you're looking to invest for the long term. You're not looking to invest for 2 hours. And so what happens now is you're not going to see people trading these index funds every single day because you just can't do that. The alternative to investing in an index fund like this is investing into an ETF, which stands for an exchange traded fund, because ETFs that you buy and sell these funds kind of like stocks. You can buy and sell these ETFs whenever you want, and some index funds have ETF versions of them too. Like if we go back to the Vanguard website, you'll see that this index fund also has an ETF version. It says it right below the title, also available in an ETF. If you click that button, it will take you to the ETF version of this index fund, which is VOO. VOO is an ETF that gives you exposure to the S&P 500, so the top 500 companies in the stock market, and this has an expense ratio of 0.03%. You can find this the same way you find the expense ratio of an index fund. Just search it on Google, and on this website, it will tell you what its expense ratio is. That's how much money you have to pay in fees every single year. So here, if you invest $100, you're going to be paying 3 cents a year in fees, so almost nothing. But unlike an index fund, you can buy and sell shares of VOO every single day whenever you want when the market is open. Remember, with the Vanguard index fund, you had a $3,000 minimum investment, and those transactions only happen once a day. With VOO, you don't have a minimum investment. All you have to do is buy 1 share of this ticker symbol, and then you can buy or sell VOO whenever you want throughout the day. So between this Vanguard ETF that gives you exposure to the S&P 500 and the Vanguard index fund that gives you exposure to the S&P 500, they both charge you essentially the same fees. They both invest in the same companies. The difference is VOO, you can see the real-time price throughout the day, versus the index fund you cannot. VOO does not have a minimum amount of money you have to invest versus the index fund you do. However, The index fund allows you to automatically invest or withdraw your money versus this ETF does not. So if you invest your money through Vanguard, you can automatically reinvest more money every single month through Vanguard versus with this ETF, you cannot do that. So if you're looking for a passive way to invest your money, the index fund gives you the benefit because now your money can automatically be invested every single month without you having to do anything versus you can't do that with an ETF unless you're using a brokerage that can passively invest your money for you. The whole reason for you to invest your money into these passive investments is to see your money passively grow and compound over time. But if you want to see your money really compound quickly, you got to keep adding money to your investments. And the simplest way to do that is every single month, just add more money into this fund. So if you invest your money into the index fund, that can automatically happen. You can't do that with this unless you use a brokerage that automatically pulls money out of your savings account or your checking account and they invest this money into your fund. If you want to learn more about how to do that, our team put together an article that breaks down the basics of investing, and I'll link it for you in the description below. So ETFs work almost the exact same way that stocks do because you can buy or sell shares of an ETF the same way you do a stock. You can see the real-time price of an ETF the same way you can do a stock, and you don't have a minimum investment you have to invest minus the share price the same way you do a stock. Index funds, on the other hand, can give you exposure to all the same companies, and they let you do the automatic investing too. When it comes to your money actually being invested in an ETF or an index fund, there's an algorithm that tells the computer which company should be in your fund. So if you're investing in this ETF or in this index fund that gives you exposure to the top 500 companies, now what this algorithm is going to look at is which companies are in the S&P 500. If one of the companies in here, so let's assume Tesla for the sake of this example, tanks, and Tesla stops making money and their market cap decreases, then what this index fund will do is say, okay, Tesla is no longer in the S&P 500. They're no longer one of the top 500 companies or the biggest 500 companies. So they're going to kick Tesla out and they're going to put in whatever the new company is that replaces Tesla. So it happens passively. You don't have to do anything. This happens in your index fund for you. And because this is happening through an algorithm, through a computer, you get to pay way less fees. So between mutual funds, index funds, and ETFs, which one can make you the most money? Well, before I say that, let me just remind you that investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. In general, for the majority of people, I mean, there's always going to be outliers and exceptions to the rule, but for the majority of people in general, index funds and ETFs are going to be the better way to go because now you're going to meet the stock market returns and you don't have to pay the super high fees. Now, obviously, there are some mutual funds that are going to do great. There are some mutual funds that are going to greatly outperform the market, but there's a chance that you might not get that mutual fund. There's a chance you're going to pay the high mutual fund fees without even getting the market returns. So if you believe in the American economy, then you're going to believe in the American stock market, which means over the long run, the stock market will continue to go up. And if that's the case, then you can just get the consistent returns of the stock market by investing your money in the general stock market, by investing in an ETF or an index fund that gives you exposure to the general stock market. Between an ETF and an index fund, this is really personal preference. I mean, do you want to have the automatic reinvestment into an index fund, or do you want to just invest your money into a brokerage that can automatically invest your money for you? Personally, I like ETFs because I like the freedom that comes with them. The key to succeeding with any of these is really just consistently investing your money month after month after month and keeping your money in the market for long enough. History has showed us that the stock market and the economy always goes up. That doesn't mean it'll always go straight up. Sometimes it will come down, sometimes it will crash, and sometimes it will correct. But over the long run, it will continue to go up as long as the economy keeps growing. So if you believe in the American economy, then this is a way for you to get that upside without actually starting your own company. Real estate is my favorite place to invest my money because when I invest in real estate, I can predict how much money this property is going to make me every single month after I buy this property. And so when I'm buying real estate, my goal is just to build up a number of properties that will each property is paying me every single month. If you can make $500 a month in profit from one property, which is doable, then if you have 10 properties, that's $5,000 a month coming into your pocket in profit that you don't have to work to earn. That's $5,000 extra every single month that you can use to spend on whatever you want. I've been investing in real estate for about a decade now, and I've seen real estate from a few different lenses because I'm a real estate investor, I'm an attorney, and I used to be a real estate salesperson. And in this video, I'm going to be going over the 10 things you need to understand when it comes to buying your first rental property. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below. The 10 things that you need to understand when it comes to buying your first or your 10th or your 100th rental property is first, the location, because you've probably heard when it comes to real estate, location, 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 location. You cannot move where your property is, so your location matters. Second is understanding the cash flow, the finances. How do you understand if a property is profitable or not? What numbers do you got to look at? Third comes to actually negotiating the contract. How do you find a good price? How do you make it work? How do you negotiate that? 4 is inspections. What kind of inspections do you need? How do you make sure a property is good and that it's not going to screw you over after you buy it? 5th is financing. How do you actually get the cash to buy the property? 6th is the legal side, because the last thing you want is for your tenant to sue you because they slipped and fell in your bathtub because it was too slippery when it was wet. True story. 7 is renovating the property. How do you renovate it and how do you get the best return on your money? 8 is actually finding a tenant and renting it out. 9th is making the property passive. That way you don't have to physically work to get this cash flow. And number 10 is if you are ready to sell the property, how do you sell the property and not pay any taxes legally? Let's get into number 1, starting with the location. When you're looking for a property, before you go out and you actually make an offer and buy a rental property, the first thing you want to do is look at a bunch of different properties. You got to look at least 10 properties before you make an offer on one, because if you're just starting off, you're not going to know what a good location is or what a good property is or what a bad one is. And so you want to just start walking through homes and start walking through neighborhoods. One of the easiest things that you can do to determine if a property is in a good location or a bad location is just walk the neighborhood, walk through the streets. Is there something nice? Are the homes boarded up? Are they burned down? Or is it nice? Are your neighbors taking care of the landscaping? Is there money coming into the area, or is the money in businesses moving out? There are 3 big things that you want to look at when it comes to finding a good neighborhood or a good city to invest your money in. Crime, the flow of money, and the city laws. There are a bunch of tools on the internet that you can look at to see what the crime is in the neighborhood that you're looking to buy in. If you see that the crime is increasing, that's not a good sign, because when you buy a property, this is something you're owning for the long term, right? When you're investing in real estate, this isn't a 6-month play or a 1-year play. You're investing in real estate for a long time because you're going to own this property and you want this to pay you rent for years into the future. And if you're buying a property in an area on the verge of a downturn, then your investment is going to be more of a headache than it is a cash cow. When you're looking at the flow of money, what you want to pay attention to is, are businesses coming into this area, this neighborhood, and the city where you're investing, or is money flowing out? The easiest way you can determine this is just by going to your city hall and asking them what new developments are coming in and what new building plans do they have for that area. If they don't have much, or if you see that this building development is going kind of somewhere away from where your property is, that's not a good sign. This one is huge. I was in contract to buy a home and I went to the city and they told me that there was this vacant plot of land that was nearby the home that I was buying, and Walmart was coming in and they had plans to develop a Walmart supercenter. That was good news for me because that told me that money was flowing here. If Walmart was willing to open up a store less than a mile from my property, that means there's going to be more jobs coming. That means there's going to be more retail stores coming, because anytime you see a Walmart supercenter pop up, that means you're going to have more stores pop up in front of it and on the side of it, because Walmart drives a lot of traffic. So if there's a lot of money coming in that area, that means property values are probably going to go up. Rental values are probably going to go up because there's going to be more demand for that area, because there's more jobs and more businesses coming. So is the money flowing to the area or out? Because if the money's flowing in, then you can buy this property today and you can expect rent prices to hopefully continue to go up, because now there's more money and jobs coming into that area. And then you want to take a look at the individual city laws itself, because what you're going to see happen is some cities are more tenant friendly and some cities are more landlord friendly. A tenant friendly city is going to make it very hard for you as a real estate investor or a landlord to kick out a tenant that's not taking care of a property or that's not paying you rent. And so you want to pay attention to that, because if you are investing your money, you want to be in a city that is more landlord friendly, ideally, because if somebody is not paying you rent, you want to have the ability to kick them out without facing a whole bunch of roadblocks and a bunch of hurdles. Another thing you want to pay attention to when it comes to city laws is how strict is the city when it comes to city inspections. Now, there are certain cities that I just avoid buying in because they have these super strict standards, and they will fine you up the you know what if you have grass that grows 2 inches, or they're going to charge you a $200 permit fee if you got to change the batteries in your smoke detectors. I've already dealt with the headache and I don't want to deal with it anymore. So when I invest in properties, I'm looking at what the city laws are, and the best way you can figure this out is just by talking to real estate investors or real estate agents in your area that are familiar with investment properties. And so if you're looking at properties, talk to a real estate agent, because they can help you find some. And if they're actually familiar with real estate investing, they should understand how these city laws work, so they can guide you and help you find find areas where you won't have to deal with all the headaches. When you're investing in real estate, you have to be thinking for the next 10 years because you cannot move the property's location. I mean, if a home is beautiful, that's nice, but if it's in a really bad location, the niceness of the home doesn't make up for the bad location. One of my real estate teachers used to tell me, find the worst home in the best neighborhood, because the neighborhood is going to help drive up the home value and the demand for the property. If it's a good home in a bad area, it doesn't matter. You're going to have a really hard time making a profit on it. But if you have a bad home in a good area, now you can be sitting on a gold mine because you can renovate the property and you'll still have demand for people wanting to live in this home because it's in a good location. Sometimes that means you'd be better off paying a little bit more for a home on one side of a street than another side of a street. Like I was looking at buying a home in a city where they had a highway cutting right through the middle of the city. But on one side of the city, these homes were about 20% more than on this side of the city. But what I saw by talking to the city hall was that there was a lot of new developments coming on this side of the highway, and there was a lot of businesses moving out of this side of the highway. So it's the same city, and we're talking about just on one side of the road. But I decided to buy here, even though this cost me 20% more, because I saw that there was money flowing in this area. Over the next 5 years, rental prices here went from about $850 a month to $1,200 to $1,300 a month, while rental prices here dropped just because everybody wanted to be on this side of the road, not this side of the road. So you got to understand why your location is so important, because it's going to play a factor into how much money you make over the long term. Once you narrow down what cities and neighborhoods you want to invest in and you start looking at properties, that's when you got to understand, when do the numbers make sense? How do you analyze the finances of a property? I'm going to get to actually how you get the cash a little bit later in this video, but let's talk about understanding the numbers first. I like to be conservative when I do my financials because I have no problem if I run my numbers and then I make more money than I thought I was going to make, but I'll be a little bit more disappointed if I make less money than I thought I was going to make. So I like to do my numbers accordingly. So the way I look at it is, first I take my rental income, whatever money I think I'm going to make, and if you're working with a real estate agent, they can help you figure out what your projected rent will be. And then you want to subtract your property taxes, your insurance, your maintenance, because you're going to have maintenance if you own a property, then your management costs because you want this to be passive, and then your vacancy because your property is probably not going to be leased out every single month. You subtract these from this, and then you're going to have your net income. So let's run through an example. If you wanted to buy this property that was $150,000, what would the numbers look like? So if I bought this property for $150,000, I should be able to rent it out for something like $1,400. Maybe a little bit less, maybe a little bit more depending on where you live, but let's assume $1,400. So taxes, property taxes, I like to estimate around 2% of the property price. So if we're looking at $150,000, that's $3,000 of property taxes a year, and that is right around $250 a month for property taxes. Then insurance, or a $150,000 property, something around $100 a month in your property insurance, landlord insurance. Then for maintenance, I like to be conservative and I like to estimate 10% of my gross rental income. Hopefully my maintenance is going to be way less than that, especially if I buy a property and I renovate it. After I get the property renovated, hopefully my maintenance is going to be close to nothing, but I want to be conservative. So if I do 10% of that, that's $140 a month in maintenance. Management fees, I like to estimate 10% for management fees. Now I pay way less than that because I have a number of properties, and so I worked out a deal with my management company. I'm paying close to 5% in management fees, but if you're just starting off, you might be paying that 7 to 10% range. So if you want to be conservative, that's another $140 in management fees. And then vacancy, I like to estimate 1 month of rent a year in vacancy, because your property might not be tenanted all 12 months of the year. Somebody might move out, and so you're going to have a period of time where you're going to be leasing the property out and not making any money. So if I'm not making 1 month of rent out of the year, that means that's another $116 or so that I'm not getting. So if I add these all up, I got my calculator right here, that leaves me with a net income of $654. Let me get my black marker. So $654 a month is what I'm making off of this property. Now this is assuming you bought this property with cash. I'm gonna go over what happens if you bought this property with a loan in just a second, but you're making $654 a month, which is $7,848 a year, and you paid $150,000 cash to buy this home, which means you are getting right around a 5% cash on cash return a year. Now personally, this is a little bit lower than what I'm looking for, but this gives you an idea of how to run the numbers. numbers. When I look at a property, I'm looking for a minimum 7% return on my money, assuming I buy the property cash. Ideally 8%, but a minimum 7%. So maybe I'll have to get a better rent. Maybe I'll have to pay less money in management fees, which I'm already doing. Maybe I'll have to see if I can get a better deal on my insurance. Essentially, I gotta have more money every single month in order to make this deal worthwhile. But what happens if you bought this property with a loan? If you use debt, then you might be putting down 20% of the home value, $150,000. So you have to put down $30,000 cash, and then the bank is going to give you $120,000. So now you have the $654 a month that you have in profit, but you also got to pay your bank. And if you are borrowing $120,000, you might be paying your bank something like $560 a month, which leaves you with just under $100 a month every single month in profit. I think it's about $94 a month in profit, and this will bring your total return down on your $30,000 cash investment to right around 4%. So not the best return, but again, we're being pretty conservative here. You should be able to get a little bit better rent here. You shouldn't be paying this much of maintenance. So you can probably bump these numbers up in reality a couple percent, but I'm just trying to show you how the numbers work. So anytime you walk through a deal, these are the numbers you want to be looking at, and you want to make sure you do this analysis for yourself, because sometimes you're going to see sellers agents create their own pro formas to show you that you're getting this amazing return on this property that you're looking at, but they might not include vacancy, they might not include management, and they might really lowball this maintenance cost. And so all they're really showing you is your rent minus your property taxes minus your insurance, and they're ignoring this half. And so you want to make sure you're doing this pro forma yourself, that way you can get kind of a real idea of what the numbers will look like in your bank account, not just what they look like on an Excel sheet. The last thing I want to mention about the finances is this return that I'm showing you is just the return you're getting every single year on the cash that you have to invest today. This did not include property appreciation, home prices going up or real estate prices going up. That's just the icing on the cake. When you buy real estate, you want to make sure that this number makes sense for you. If this number makes sense for you and the real estate prices go up, that's even better. If real estate prices come down, oh well, at least you're still making your rental profits here. But the reason why your location matters so much is because now what you're going to see happen over the years is this top line rental number is going to go up, while at the same time your expenses aren't going to change too much. Yeah, they'll go up a little bit, but they're not going to go up as fast as the rent as long as you're in a good location. So what you're going to see happen over the years is the return that you're getting on your cash is going to increase every single year that you own the property, because you're going to see your rental prices go up with expenses not growing as fast, which is why you want to own a property in a good location. And then when it comes time to sell, the advantage here is, let's say the property value doubles to $300,000. In this instance, you put down $150,000 and you doubled your money, because now you're getting $300,000 when it comes time to sell. Here, you only put in $30,000, and then you're going to make another $150,000 in profit on the sale price, because you only put down $30,000 and then you make another $150,000 on the appreciation of the property. Now, when you find a property like where the numbers make sense, now it's time for you to negotiate the contract, because you want to make sure you get the best deal possible. And the type of negotiating and the leverage that you're going to have is going to depend on what type of market that you're in. If you're in a seller's market where property values keep going up and everybody's trying to buy a property, then you're not going to have as much negotiating room as you would as if you were in a buyer's market when everybody's trying to sell their home and home prices are going down. During these markets, you can be super aggressive with your offers and still probably buy the home, just because that's the market that you're in. Things that I do to find the best deals is, one, when I look at properties, I'm not looking at the super nice homes. I'm looking at kind of those medium range homes, not the super bad homes and not the super great ones, right in the middle range, because I found those to give me the best returns. And second, when I try to find properties, I like to find properties that are beat up, either beat up physically or beat up financially. In the real estate world, they're called distressed properties. I like to call them value add opportunities. Essentially, I like to find a property, if it's physically beat up, that is cosmetically challenged. So it might have really bad floors, the paint might be ugly, the kitchen might be outdated, the landscaping might be horrible. When a regular person walks through this home, they're gonna be like, oh my God, this looks ugly and it smells, I don't wanna look at this, and so they're gonna walk out. For me, that's a great opportunity, because now I'm not really competing against anybody to buy this home, so I can buy this property way below market value, and I can renovate the property and make it look brand new, and then own this property at a huge discount below fair market value. If you're looking at commercial properties or multifamily apartment complexes, you can also find a financially distressed property, which means you might have a 20-unit apartment complex, and this apartment owner, this real estate investor, doesn't know how to manage the property, and this 20 20-unit apartment complex, has nobody paying their rent, and it has a lot of vacancies. And so this is financially distressed because this apartment owner, this real estate investor, is losing a lot of money. And so they just want to get the property off of their books. So they're willing to sell it at whatever price because they just want to get rid of it. If you are an experienced investor and you have the right team, then you can come in and buy this property and turn it around and make a much bigger profit because now you're buying this property for way below market value. The key for any of this to work is you got to put your emotions on the side and you got to focus on the numbers. So many people get caught up on the emotions because they want to invest in a cute home. But when you invest in a cute home, you're going to have cute profits. If you really want to make the money, you got to invest on the numbers, right? So if you're looking at a property and it's ugly, it might not look nice, but you can turn this property around and make a lot of money on it if you look at the numbers. When I was first looking at properties back during the 2008 crash, I took my mom with me a few times, and these properties were ugly. I mean, they were beaten up, they had mold and mildew inside, but they were selling for dirt cheap. And I remember my mom telling me, oh my God, I don't want to be in here because these homes are so nasty. I mean, there was holes in the walls, there were sometimes animals living inside. So a lot of these homes are super beaten up because this was in Michigan, which was really hit hard by the 2008 crash. And a lot of these homes were selling for $5,000, $6,000, $7,000. And now today, these homes are worth almost $100,000, rented out for $1,000 a month. But I didn't buy some of these just because I got emotional and I didn't realize that I could have turned these kind of like crap properties into gold mines if I just understood to let my emotions be on the side and understand the numbers. This is where you got to understand that real estate investing is not for everyone. I mean, you got to get down and dirty and you got to work with a bunch of people. You got to find the real estate attorneys, the real estate agents, the real estate contractors, and the property managers. And so you got to find these people, work with them, and really understand how the process works. If you're not interested in that, then it's going to be hard to really be a successful real estate investor. I mean, yeah, you could just throw in money and find somebody to go find you the deals and do all that, but you're going to get a lower return because you're not willing to go out and actually find the deals and maybe renovate them. You don't have to do single family homes. You can do much larger apartment complex and you can do more commercial properties, but if you're not willing to go out there and put in the work, you're going to have to pay the price for that in lower returns. Now, there are alternatives with things like real estate crowdfunding, where now you can just invest your money and get exposure to a real estate fund. That way you don't have to deal with tenants or property managers or any of that. So if you want to learn more about that, our team put together an article that breaks down how you can invest in real estate without actually buying physical real estate. If you want to read the article, it's on our website, theminoritymindset.com, and I'll link it for you in the description below. But when it comes time to negotiating the contract, one thing that no matter what you are doing when it comes to price, one thing that you have to incorporate is a property inspection contingency, which says that you have the ability after you enter into a contract to go through the property with your own private inspector or your city inspector, and then you can decide if you want to continue buying this property or not. It is so important, and let's talk about it in number 4. Not doing your proper due diligence and getting the right property inspections is one of the easiest ways to make a deal go bust. I'm telling you this from experience. There was one deal that I did. It wasn't even a big deal. It was a small home that I bought because a contractor that I was working with told me that this would be a great investment. I purchased the property based off of his word without doing any of my own private property inspections, and that single deal came around to bite me in the butt, and it was one of the biggest headaches I had ever had to deal with in real estate. I made a video where I talked about this in my worst real estate deal ever. If you want to watch the video on YouTube, I'll link it for you in the description below. But essentially, if you have a property inspection, you can take a private contractor, a private inspector, and this person's job is literally to just walk through the entire property and make sure your property is not on the verge of falling apart. So they're going to walk through and see the foundation of the property. They're going to see how the roof is. They're going to see the mechanical, the electrical, your plumbing. So they're going to go through the entire property and make sure the systems in the property are working, because the last thing you want to do is buy a property and then find out you need $100,000 worth of renovations when you only budgeted $6,000 worth. Getting a private property inspection is going to cost you a few $100s. And this is money you have to pay before you actually buy the home, because as soon as you enter the contract, you want to have the contingency period, this due diligence period, where you can inspect the property with your inspector. And so you're going to pay this inspector a few $100s, and they're going to go through the property and they're going to give you a report which tells you everything that's wrong with the property physically. And once you get that report, you can decide if you want to continue buying this property, or if there's a lot of repairs and renovations that need to be done. You can tell the seller, hey, I need a discount on the price, because right now they're kind of like on the hook, because if you don't buy it, then the seller has to start the selling process all over again. And so you kind of have to make this decision as to if you want to negotiate how much, or do you want to just walk away from the deal, or do you want to accept the deal as is. In addition to getting your own private property inspection, you also want to consider having the city come out and have them do a city inspection, because most cities require you to register your property as a rental. So you're going to have to work with the city hall and tell them that you want to rent this property out, and they typically are going to come out and do their own inspection and make sure that this property is livable and there's not any major issues. If you do a private property inspection, you should find all the major issues, but the city might tell you something that you didn't expect, or they might make you do things that you didn't know you had to do. So you want to talk to the city early on, and you want to know exactly what your costs are going to be before you actually buy the property. That way you can do your financials and your numbers based on what your actual costs are going to be. So before I buy rental property during this due diligence period, I do three things. First, I get my own private inspector to go out and walk through the property and tell me what's wrong with it. Then I like to have the city come out. That way the city can tell me what I need to do to get this property licensed for rental. And third, I'm going to have my contractor go through the property. That way I can show him a private property inspection, the city inspection report, and then whatever renovations I want to get done. That way I can see what my total costs will be to get the property renovated and ready to go before I actually buy the property, so I can look at the numbers. Now, one little caveat I want to give you is anytime you get renovations done, chances are it's going to cost you a little bit more than what you expected. So just kind of budget that in there and understand that, because almost always you're going to pay more than what you thought to do the renovations. Once you find a property that passes your due diligence, now you got to get the cash to actually buy the property. This isn't something that you want to start after you enter into contract to buy the property. If you're talking about getting financing or getting cash, you got to know how you're going to get the cash to buy the home before you even start looking for homes. But now is when you got to get serious and actually get the cash to buy the property. And when it comes to getting the cash, there are three ways that you can purchase real estate. You can buy a property all cash if you have enough money in your bank account. You can use equity partners. So if you want to buy a $150,000 property, you and two other people might front $50,000 each, and now you three are equal partners in this property, and you're going to share in the profits, in the rental profits, and when it comes time for you to sell the property, assuming that you make any money. And then you can use debt, where you can borrow money and pay this money back plus interest. And the way you can get this debt is through a bank, or you can do a land contract, which is when the seller of a property gives you the cash to buy their home. If you're like most people and you don't have all the cash in your bank account to buy a property, then you're going to have to do one of these two. And these are two things that you want to start preparing for before you actually start looking at properties, because you want to make sure you have the cash ready when it comes time to actually close. Like if you're going to go get debt and you want to borrow this money from a bank, your bank is going to want to see your income statements for at least the past 2 years so they can see that you have stable income. They're going to want to look at your credit score. If you want to get the best rates, you want to have a minimum of a 760 credit score, and they're going to want to see your experience and your reputation. So the bank wants to see that you are a safe investment for the bank's money. A land contract, on the other hand, is when you want to buy this property right here, and you tell the seller, okay, I want to buy this $150,000 property, but I can't qualify for a loan. Either I don't have a good credit score, or I don't have enough income to show the bank, or whatever. I can't qualify for a loan from the bank, and so I will give you, the seller, $10,000 today, and in exchange, you hold back a note, a loan, for the remaining $140,000. So the seller will only get $10,000 today. That's what you give them. And then every month after that, you're going to pay the seller interest on this $140,000. And so the term typically on a land contract is usually 5 to 10 years. It's not usually a 30-year term like you see with banks, because these sellers want to get their money. And the interest rate you're going to pay on a land contract is typically higher than what you're going to pay if you got a loan from the bank, because the seller understands that if you could get this money from a bank, then you wouldn't be asking the seller for a land contract. So a land contract is an easier way for you to get money, but you got to pay an extra fee for it. And one thing that people like to do is maybe you can go buy this home, use a land contract to get it, and then once you're ready, you can go to the bank, refinance this home. That way the seller can go out of the picture, you pay off the seller, and now you're paying this lower interest rate to the bank. But the thing you got to be aware of here with refinancing is if property values go down, then it becomes harder for you to refinance. So you just got to understand the risk. And the thing about debt that you have to understand is the more debt that you take on, the more risk that you take on. So I want to make sure you understand that when you're buying this property, you're buying cash flow, you're not just buying a headache. And so you don't want to take on too much debt. This is one of the things that people get really excited about in real estate. Is there's this whole industry of people promoting the no money down real estate, where you might do something like buy this $150,000 property where the bank is going to give you 80%. They'll give you $120,000, and they'll say get the other $30,000 from the seller through a land contract. So the seller gives you $30,000 because they don't need all that money today. You pay it off over time, and then the bank gives you the other $120,000. So you bought this property with no money down, and now hopefully you can make a profit, and if property values goes up, that's all your money. Now, while this sounds great in theory, it also comes with the most risk, because if your tenant stops paying or if your tenant damages the property, you have no skin in the game, and if you don't have money to take care of that and to cover your costs, now you're going to be the first one to go underwater and get the property taken away from you by foreclosing on the property, because the bank or the seller is going to ask for the property back. So debt is a tool, and it can be a good thing, but too much of a good thing can be a bad thing. So if you take on too much debt and the economy slows down, you're going to be the first one to lose everything. Now, if you come to equity, this is where now you're going to have partners in the deal. There's a couple ways that you can do this. In some instances, you're going to see that you have doctors or attorneys, these high-income people who might have a lot of money but don't have the time to go and invest in the property. You can go to these people and say, hey, give me 15% equity in a deal and we'll work on deals together. So you go out, you find the properties and you manage them and you make sure that they're profitable, and this cash provider, this rich person, is getting 85% of all the profits. You get 15%, so you're managing the deal. You don't have to put in any of your own cash, but you get 15% equity. Or the alternative is you find a couple partners, you want to buy this $150,000 home, you all put in $50,000 each, you're equal partners in this instance, and so every time you make profit with your rent, you guys split the profit, 1/3, 1/3, 1/3, and when it comes time for you to sell the property, you share the profits 1/3, 1/3, 1/3. You can compare that to debt, where in this instance, let's say this property sells for $1 million, okay? In this instance, the bank and the land contract owner are only gonna get whatever money they were in contract to get. So they're only going to get this $150,000 plus interest. They don't get any of the profit. Here with the equity holders, you only get 1/3 of the profits because you only own 1/3 of the property. When you buy a property with cash, then it's simple. You're just using your cash to buy the property. If you are a cash buyer, here's a little hack that I've used in the past that you might like. So if you want to buy this $150,000 home, what you can do is you can go to the closing table and you can buy the property for $150,000. But one thing that you can do is, let's say you're buying this property through an entity. I'm going to talk about this in just a minute. Now, instead of you depositing $150,000 into this entity and then buying this home, what you can do is, instead of you depositing it into this account, you can loan this money to your account. So now this entity that you own, I'm going to talk about this legal entity in just a second, but you own this entity that owes a loan to you. So now when you buy this property, you still have to make loan payments, and this loan payment goes back to you. So now your real estate investment has more of an expense because you have to pay interest, but all that money is going to you. So you get a bigger deduction and the interest tax break. Now, although I am an attorney, I'm not your attorney. So if you have specific tax questions or legal questions, talk to a professional in your area. This brings me to number 6, understanding the legal side of real estate, which means you got to understand what an entity is, a real estate entity, understand real estate insurance, and having a real estate attorney on your side. So when I buy real estate, I never buy real estate under my own name. Like, I don't actually own any real estate. I own real estate companies which own real estate. So the way it works is like this. This is me, and you know, I gotta draw me a nice mustache. I own this entity right here. Let's call it JS Real Estate. So I own JS Real Estate. This JS Real Estate might own this home right here. I don't actually own the home directly, because if I own the home directly and something bad were to happen, let's say a tenant lived in here and they slipped and fell in the bathtub because they said the bathtub got too slippery when the water was on, true story, and then they sued me. If I own the property, then they'd be able to come after me and my personal assets. But if this property is owned by JS Real Estate, then the most they can get, assuming that insurance doesn't cover this lawsuit, the most they can get is whatever this entity owns. And so this entity that I have, in this case, it might be an LLC. You got to ask an attorney in your area for what's best, but in most instances, LLCs are the best way to go. This entity is kind of like a barrier or protection that protects you and your personal assets from lawsuits and anything bad going on with your property. There's a saying in the real estate world that if you are a real estate investor and you haven't been sued yet, then you haven't been in business long enough. I mean, this is just the reality of being a real estate investor, especially in the United States, because you can be sued for anything. Like, I had a tenant sue my real estate company because they claimed that the bathtub was too slippery when the water was on. True story. I already made a video on YouTube where I talked about that, so if you want to watch that and learn more about what happened, I'll link that for you in the description below. But this is where you got to understand, okay, what can I do to protect myself? That way I can protect my personal assets, and the way you can do that first is by creating this legal entity. The second thing you want to do is have real estate insurance. This real estate insurance is there kind of as the first shield before the entity, because this real estate insurance is there to protect you from anything bad happening. Like if a tenant slips and falls, or if the tenant sues you, first thing they're going to do is go after your insurance. So this insurance is there to protect you from lawsuits, and it's also there to protect your property, because if this property gets burned down or something bad happens to the property, that's where insurance is there to protect your assets. So insurance is your first line of defense. If the insurance fails, or if they don't cover you for whatever reason, this is where your entity is your second line of defense to protect you and your personal assets. The third thing that you want to make sure you have on your side throughout the entire real estate process is a real estate attorney. From the minute you start negotiating deals in real estate, you want to make sure you have a good real estate attorney on your side, because they're going to help you review your purchase agreements, they're going to help you review your due diligence, they can help you negotiate the contract with your contractors, and they can help you deal with city inspectors. You need to have a good real estate attorney on your side. I know it can be expensive, but it's a small price to pay today that can save you a huge headache in the long run. You want to make sure you have a good attorney that specializes in real estate. You don't want to just get a general attorney. I'm telling you this from experience because I am an attorney. There's a lot of kind of complexities and little things involved in real estate. So you want to make sure you have an attorney who's very familiar with real estate, not just a general attorney, because they can protect you from huge headaches in the future. Now, moving on to number 7. Once you get this property, now you want to start renovating it and get it rent ready. But you want to make sure when you're renovating it, you're getting a good return on your money, because you just don't want to throw all your money into these fancy renovations that they're not going to pay you any more money. So the first thing you got to understand is what sells a home, or what gets a home leased out. That's kitchens and bathrooms. If you do decide to make upgrades in a rental property, those are the two places that get a lot of attention, kitchens and bathrooms. So if you do decide to make renovations, look at doing things there. The next thing you got to look at is the durability of your property, because if you have tenants moving in and out of your property over the years, then you want to make sure that the renovations that you do can last you for a long time, because the last thing you want to do is constantly keep having to repair and maintain a property every time a tenant moves out. So one thing that I like to do is have minimal or no carpet at all in a property. A lot of my rentals actually have this thing called laminate vinyl planks on the flooring, which is something that looks kind of like hardwood, but it's not hardwood, and it's also waterproof, so it's durable. And unlike a carpet, I don't have to replace it every time a tenant moves out. So it's easy to clean, easy to maintain. It costs a little bit more in the beginning, but it saves you a lot of money in the long run because it's durable and it looks really nice. In the kitchen, one thing that I like to do is upgrade the appliances. I like to put in brand new stainless steel appliances, because people like appliances they're going to be using a lot, and stainless steel looks nice. And if you take care of your tenants and you make them feel at home, then they're going to take better care of your rental property, and they'll be more likely to stay there for longer. An easy way to understand the level of renovations that you need to do in your area is just by walking through other rentals in your neighborhood or in your city around your property. That way you can see what other real estate investors are using, because the last thing you want to do is put in super expensive granite countertops when people are not willing to pay for granite countertops in your area. So just walk through a few rentals and see what people are putting in and see what people are charging for rent. Remember, your goal is to make money, and so if you're doing renovations, you want to make sure you're getting a good return on the renovations that you're putting in the property. Now, once you got the property renovated, it's finally time for you to rent it out and start making money. Now, you can rent out the property yourself and you can show the property and do all that, or you can use a property management company or a real estate agent. I recommend using a property management company. That way this whole process is automated and passive. I'm going to talk about that in the next step. But if you do decide to rent the property out yourself, you got to understand what you got to look for when you're trying to find a tenant. Because when you find a tenant, the last thing you want to do is you find somebody who says, hey, can I move in tomorrow? And you tell them yes, and then you just move them in and have them sign a lease. Because typically what you see happen is somebody who wants to move in immediately is also the person you got to kick out very fast. You got to do your background checks on tenants. So you can look at their credit score, you can look at their criminal history, and you can look at their past rental history. Typically, I don't really care too much about someone's credit history, because there are so many things that can negatively affect one's credit score. I want to look at now your income, how much money you're making, are you consistently making money, and what is your past rental history. So I will call, or I'll have a property management call your previous landlords and ask them how you were paying. Were you paying on time? Did they have issues with you? If you're paying on time and you don't have a great credit score, maybe you went through a divorce or something else, then it doesn't matter as much. I just want to see, are you making enough money to support this rent, and are you going to have issues paying this rent 6 months from now? If you use a real estate agent or a property management company to rent out your property, typically Typically, they're going to take 1 month's worth of rent as their commission for leasing out the property. This is a fee that they take in addition to their monthly fees. So just factor that in, because if you have an agent or a property management company do this and you're charging $1,000 a month, they're going to take the first month's rent, $1,000, for getting your property leased. If your goal is to be a real estate investor, a true real estate investor, then you shouldn't be spending all of your time managing your real estate. Your job and your time should be spent finding more real estate investments and finding more real estate deals. That's why I don't manage any of my properties. I have a property management company that does all the day-to-day work. They find my tenants, and I don't even know who my tenants are. All I see is a report every single month which shows which properties are paying what rent and what the rental income looks like and what the expenses are. A property management company's job is to make a real estate investment passive for you. So they're going to take a fee every single month, typically somewhere between 4 to 10% depending on how many properties you have, and then they're going to charge you 1 month's worth of rent to list out your property, which is why you want to have tenants in your property for as long as possible. That way you don't have to keep paying that listing fee. But this real estate property manager's job is to really make it easy on you, because after you find the property and you get it renovated, you just want to hand over the keys to the property management company and let them do their job, find the tenant, and make sure that you get paid. A good property management company is going to know how to screen a tenant. They're going to have contracts and deals with a lot of contractors. That way you can save money on your renovations, and they're going to pay all your bills. They're going to pay your property taxes. That way all you have to do every month is just read your reports and see how much money you're making and let them handle all the work. I think every new real estate investor kind of goes through this phase where they're thinking, okay, I'm going to make $1,000 a month from this property, but why do I want to pay this property manager $100 a month or 10% of the deal? I could keep the extra $100 a month in my pocket if I just manage it myself. Yeah, you could make the extra $100 a month if you manage the deal yourself, but now you got to spend the time managing the deal and making sure that all the bills are paid and making sure that your tenant is paying rent. If instead of worrying about making the extra $100 a month, you worry about how do you create a new rental property and make a new stream of income for $1,000 a month, then the $100 a month expense doesn't seem so bad. So I want you to think about growing the pot, not just worry about how you can stop saving these expenses, because you as an investor don't want to be caught up in the game of managing. You want to be caught up in the game of how do you find more investments and how do you create more real estate deals. You want to think bigger, not just smaller. Now, you got this property, you've been renting it out, it's cash flowing, it's making you money every single month, and now let's assume it comes time where you want to sell this property and you want to cash out, because let's assume that you bought this property for $100,000 and let's assume that now it's worth $1 million. So now you have all this equity built up on this property and you don't want to refinance out of this property. You just want to sell and you want to be done with it. The advantage of you being a real estate investor is there are certain loopholes that you can use, legal loopholes, to sell this property and not pay any taxes right now. So this loophole is called 1031. It's the 1031 exchange, and essentially what it says is if you sold this property today for $1 million, then you'd have to pay taxes on your profits, in this case $900,000. Instead of you paying taxes on $900,000, which would be a lot of money, what you can do is you can take all of this $1 million and you can take this $1 million and use it to go out and buy another real estate investment property, a bigger property, and now you don't have to pay any taxes on your profits today. So you invested $100,000, this property is now worth $1 million. Now you go out and buy $1 million property and you don't have to pay any taxes on your profit, and now you got more income coming in because you're not having income on a $100,000 property, you're having income on $1 million property, and so you can have more cash flow, more passive income, and you don't have to pay any taxes on your profits. This is not something that you can do in the stock market. If you invested $100,000 in the stock market today and your investments go up to $1 million and you sold it and you use this $1 million to go and buy new stocks, that might be a good investment strategy, but you still have to pay taxes on your profits. So while you invested $1 million, you still have to pay taxes on your $900,000 worth of profits. So if you don't have the money in the bank, then you might have to sell some of your stocks. That way you can pay your tax bill. You don't have to do that in real estate because of this loophole 1031, which lets you flip real estate, and now you can own bigger real estate without having to pay any taxes on your profits. Plus, there's no limit to how many times you can do this. Like if you bought this property for $100,000, it goes up to $1 million, and you sell it and you buy $1 million property, then you can take this $1 million property, sell it, and you can use your profits to go out and buy a $2 million property, and you can do that again and again and again. So there's no limit to how many times you can do 1031, which can allow you to compound your wealth, because I'm sure you've heard of compound interest, and you don't have to pay any taxes, which could eat away at your wealth if you keep doing 1031. If you do decide to do this, talk to a real estate attorney early, because there's a lot of kind of little rules and details you got to follow in order to do 1031 the right way, and you don't want to accidentally get caught with a surprise tax bill. So make sure you talk to an attorney, because if you want to do this, you want to make sure you do it right. Before we get into into the next clip, I do want to let you know that if you are interested in learning more about money management and investing, our team has put together an amazing guide that walks you through financial education, that way you understand how to use your money, how to manage your money, and how to invest your money the right way. This guide is completely free when you sign up for our newsletter, and it will walk you through the things you need to understand about financial education and managing your money and investing your money the right way. So if you want to download our free guide and get our free newsletters, I got the link to how you can download our guide in the description below. Every single time a market crashes, it doesn't matter which market crash we're talking about, two things happen. First, people are blindsided and they lose a lot of money. And second, people always start praying and hoping that this never happens again. Now, while history doesn't exactly repeat itself, it does rhyme. And so what you want to do is you want to be in a position where you're starting to prepare for the next market crash right now. That way you can not just survive, but thrive through the next market crash. Because the interesting thing about market crashes is you see more millionaires created out of market crashes than any other time. Look, I'm sorry to be the bearer of bad news, but the market will crash again. I have no idea when it's going to happen, and everybody has a prediction as to what's going to cause it, like all this quantitative easing, free money, high unemployment. But the market will crash, we don't know when, and so you need to be in a position where now you're preparing for it. That way you are ready, that way you can survive and thrive through the next market crash. My mind has to systematize things, which is why I love outlines so much, which is why if you want to know how to survive and thrive through the next market crash, there are 5 things that you need to understand and know, which is what I'm going to be going through in this video. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below. I've always been kind of like a tough guy. I played football in high school and I try to lift every single day, but I also really like tulips. Tulips are my favorite flower because I like the way they look. But the interesting thing about tulips is they're also a symbol for financial education. Tulips are originally from Turkey. And when Turkish merchants brought tulips to the Netherlands, the Dutch fell in love. And tulips kind of became like this symbol of luxury because they were this really rare flower and obviously they're really beautiful. And then what happened is you saw people in the Netherlands start to buy tulips, not just because they're a nice flower, but because people wanted to own them as a status symbol. And so then people started to buy up the price of tulips, and you saw the price of tulips started to rise. Now the Dutch farmers and merchants were getting rich buying tulips because they would buy tulips one day, and then when they would go around to sell the tulips, they would be able to sell it for so much more because there were so many people that wanted to buy tulips and not enough tulips out there. Everybody wanted tulips in their garden because it was a real status symbol, and if you had tulips, it meant you were rich. And so now these farmers and merchants were getting so rich that the investors started to get excited. They thought, if the farmers and merchants can get rich by buying tulips, why can't we do it too? So then the investors started buying up tulips, not to sell them in the open market or to plant them, but because they saw them as a great investment. Now here's the thing, if you're an investor, you don't want to be the person going to auctions or growing tulips or doing any of that. You just want to be in the business of managing money. So the investors then started creating tulip derivatives. That way they didn't have to own or take care of these actual tulip bulbs. They could just trade these pieces of paper. So now investors started creating these tulip derivatives, and lots of people had the ability to now go out and buy tulips on paper because now you can invest in tulip bulbs. That's when tulip prices really started to skyrocket because now you had everybody trying to buy tulips, not to plant in the front yard, but so you could get rich because tulips were going up in price so fast. It got to the point where people were literally selling their houses or refinancing their houses. That way they could go out and buy one tulip bulb because tulip prices were going up so fast and everybody was getting rich buying tulips. Now you have tulip bulbs costing as much as a house, and you have these farmers and merchants sitting on all these tulip bulbs thinking, wow, we are rich. Let's sell some of these tulip bulbs, that way we can cash in on all of our profits. So the farmers held an auction to sell out their tulip bulbs, and guess what? No one showed up. Nobody actually wanted to buy the tulips, and nobody really wanted to pay that much money to own a tulip bulb. People were buying tulips not to own tulips, but just so they could get rich quick. When the farmers started to realize that, they had to cut the prices of the tulip bulbs significantly so somebody would actually buy it, and that's when the price of tulip bulbs crashed, and now everybody that had refinanced their homes or sold their homes to buy a tulip bulb were left holding nothing except a pretty flower. This is a true story. It was called Tulip Mania, and it happened in the mid-1600s, and this was the first recorded financial bubble in history. After that financial bubble, we've seen market crashes happen again and again and again, not with tulips, but with other assets because people will always be greedy, people will always be looking for speculative investments, and people will always look for a way to get rich quick. When you have all three of these things that are fueled now by cheap and easy debt, that's how bubbles are created. And once a bubble hits a peak where now people are not willing to buy more of this thing, that's what causes the bubble to burst, and now you have a bubble boom and bust. That's why the first thing you gotta do if you wanna be able to survive or thrive through the next market crash is understand market crashes. So every asset class and our economy goes through cycles, kind of like this, where you have boom phases and bust phases, but over time, you see the overall kind of baseline of this thing go up. So if you're talking about the stock market, you see stock prices go up and down and up and down and up and down. But over time, you see the value of the stock market go up. When people talk about market crashes, the most common thing that they're talking about is the stock market. And you see these type of stock market booms and busts happen every 8 to 15 years or so. What happens is people start buying assets and the economy grows and companies grow, and then the price of these assets start to go up. And that's when the media comes out and they say that this asset price, the stock cannot stop growing and it's booming. And this gets more people excited. Then people start coming and buying more. And now the media gets even more excited, talking about how everybody is getting rich, and now the speculators get so excited and everyone's talking about how they're getting rich, and so now people are going into debt, talking about all these stocks and assets that they're buying, and now you're going on your Uber drive and your Uber driver is telling you about how they refinance their home, that way they can put their money in the market, and this causes asset prices to soar even more, and eventually you hit a breaking point where asset prices go up way too high, and once that happens, people stop buying the stock or they stop buying this asset, and this causes prices to cool down. Once things start to come down a little bit, now the media comes out and they talk about how everyone's losing money and how the stock is starting to struggle and how a lot of people are starting to sell, and this causes prices to come down even more. So now people start panicking because you had all these people buying these prices right before the top, and then things start to come down, especially if you're leveraged. Now you're really in the red, and so people start panic selling. This causes the media to come out talking about how everybody is losing money and why if you want to survive you have to sell everything now, and this causes prices to go down even more. And then you have people coming out thinking, wow, this price of this asset or the stock is really low. It's below what I think it's worth. And so now people start to come back in and they start to buy, and that's when you see the cycle start all over again. Warren Buffett has a great quote on this. He says that bubbles happen because people see their neighbor who is dumber than they are get rich, and so they want to buy in too. When you see a stock in the news talking about how the stock is starting to go up, you might be a little bit skeptical, but then you start to hear about all of your friends buying the stock and making all this money, and you're like, well, if they're making money, I might as well do it too. So that's when you come in and you buy, and you might not even know why you're buying it. You're just buying the stock because everybody else is doing it and it looks like it's going up, and so now you buy in, and then you might see the stock go up a little bit and you're thinking, wow, if I had just leveraged up my bet a little bit more, I would be able to make so much more money. So now you, being the genius you are, you leverage up your bet through the help of margin or debt, and now you own all this stock, and you might not know why you're investing in it, but you're making money, and then eventually things get a little bit too hot, and that's when things correct, and now you're in the red, and now you're panic selling. That's why the very first thing you gotta do before you can do anything else is you gotta understand how the game works, because the majority of people are playing in this game, but they're playing on the losing side. They come in and they buy here out of greed, and then they panic and they sell here because they start to worry and they start to lose money. And so you gotta understand how the game works, that way you can win in the game. The second thing you gotta do is you gotta be prepared, because market crashes can happen at huge extremes. You can have like 2008 economic depressions, or you can have smaller economic crashes. The way you do that is just by preparing your own personal finances, that way you are ready for anything. First thing you gotta do is you gotta have an emergency savings fund. If the economy crashes and your company goes under and you don't have a job for a little while, you need to have some cash that you can fall back on, that way you're prepared. So you wanna have something like 3 to 6 months worth of expenses saved in a savings account that's there liquid, just in case something bad happens, that way you can fall back on that. Second thing you wanna do is pay off some of your consumer debt. This might be your car or your credit card debt. If you have this consumer debt, this is debt on things that are not making you any money, pay it off. Once you lay your financial foundation, then you want to get a little bit on the offensive by diversifying your assets or having different income streams. That way, if something bad was to happen, you are not financially devastated. Maybe you have different income streams like real estate rental income and dividend income instead of just your job. That way, if something were to happen to your job, you do have some other income to fall back on. And you can have different types of assets. Maybe you have some stock assets. Maybe you have some hard assets. Maybe you have some cryptocurrency. That way, if things were to go bad, your money isn't tied up in just one asset class, because if you see the stock market crash, your other assets might be okay. But the interesting thing about diversification is when the majority of people talk about diversification, they're really not diversified at all. They say something like, yeah, I'm diversified. I got some of my money in blue chip stocks, and I got some emerging economy ETFs, and I got some growth ETFs, so I'm diversified. But all of your money is just within one asset class. It's all in stocks, paper assets. And so if the stock market crashes, all of your stocks, all of your funds go down. If we're talking about being really truly diversified, that means having your money in different asset classes, having some of your money in stocks, paper assets, having some hard assets like real estate, having some commodities like gold and silver, and now maybe even having some cryptocurrency. The whole point of this type of diversification is really to protect you from any type of scenario, because the next thing you got to understand is 3, when the market crashes, you got to remember your goal. The reason why you really got to know your goal and your strategy, because one stock might be a great investment for one person, but that same stock might look like a losing investment to another person. And so if I came to you and I asked you, is Tesla a good investment? The answer is, it depends. What's your strategy? What's your goal? Are you a value investor? In which case you're looking for a beat up and undervalued company that you can buy and hold for the long term where the company turns around? If that's the case, then maybe not. But if you're a momentum trader and you're looking to make some money quickly, then this could be a great investment if you can come and buy and sell it and make money. If you are a long-term value investor and you're investing your money in the stock market for the long term because you want to build long-term wealth, and you come in and you buy here, and this investment that you buy comes down to here, then you don't want to be panic selling as long as you believe in the underlying value of investment. The only thing that you want to do is come in and buy more. I'll talk more about that in just a minute, because you have a long-term horizon. You're not trying to buy and sell your stock in 6 months or a year, because you are trying to invest in this company or this ETF for the long term. But if you're a trader and you want to make money quickly and you buy here and you see the stock come here, then you got to have your risk parameters in. At what point do you sell? Because if you see your stock coming down, then you might want to just sell quickly, because you don't know, maybe the market is just correcting or maybe it's crashing, but you want to make sure you have your risk parameters in there because you're trying to invest for the short term. And so if you come in and you're like, all right, I'm buying here and I want to be a long-term value investor and I believe in the underlying value of this company or this ETF, and then you start to see this company or this fund come down, and now 6 months later you're like, you know what, I'm just going to cash out right now, that way I can cut my losses. Well, now you're kind of switching sides. What is your strategy? Are you a trader or are you a long-term value investor? Because if you still believe in the long-term value of this company, you're just not happy with the price, then you are switching sides. That's why you got to start by understanding your goal and knowing what your strategy is, because if you're investing for the long term, then you got to understand market crashes are a part of the game. And speaking over the long term, what we've seen happen time and time again is that over the long term, you see the US economy, strong companies, and the stock market continue to go up. Now, that doesn't mean that it always continually goes up in a straight line. We see it kind of go through these waves like this, but over the long term, the market corrects, and so do strong companies. And so you got to understand, if you are a long-term investor, all you got to do is ride it out. If anything, come in and buy more. That's why the fourth thing you got to understand is don't panic. If you come in and you buy the stock right here, let's assume you buy it for $100 a share, and then it goes up to here at $200 a share, and you don't sell it, it might look like you made $100, but you don't actually make any money until you sell your stock. So on paper you made $100, but you haven't actually made any money. And then let's assume that the market crashes and the price of the stock comes down to $50. At this point, it looks like you have lost $50 because you put in $100 and now you're down 50%. But again, you don't actually lose any money until you sell. This is where you have to be able to manage your emotions. And it sounds silly, but the people that can manage their emotions can make the most money in the stock market, because now you're thinking financially, not emotionally. And when things come down, you remember your strategy and you remember why you bought. And so now you keep the long-term horizon in mind. Now look, sometimes this can be really hard, because when you own a share in a company and all you see is this company going lower and lower and lower and lower, you might think it's the end of the world. But one thing that you have to remember is that a company's stock is different than the actual company. And so you got to remember, if the company is doing okay, this is your research. So if you are a long-term investor, you have to be doing this research. If you see that this company is doing okay and they're still growing and they're able to grow and turn around, then this might be a company you want to continue holding on to. But you also don't want to just go down with the ship, because if this company goes bankrupt, you lose everything. So the first thing you got to do is you never want to invest more money than you can lose. That's why trading on margin has its own risks. So you got to first understand how much money you're putting in. Are you okay losing this money? Second is you got to understand your strategy. If you're a trader and you start losing money, you got to have your risk parameters. At what point do you sell? If you are a value investor, if you're investing for the long term, you got to understand what factors are you paying attention to. That way, if this company starts to go under, when are you going to sell? This is where the best thing that you can do is remember what your original goal was. Is a long-term investing or short-term trading, and make your decisions based off of the research on that. These 4 things that I just talked about are going to help you survive through a market crash better than the vast majority of people. Now, if you really want to thrive through a market crash, you got to come in and number 5, buy. When you see a market crash happen, it doesn't matter what asset class we're talking about, whether it's cryptocurrency or stocks or real estate. When you start to see these asset prices crash, the people that come in and they buy are the ones that come out as winners over the long term, because now you get to buy a great asset at a discounted price because everybody is panic selling, and this is when you want to come in and buy. But there's some tricky parts to this because some people are trying to be traders, right? And if you're trying to trade and you have a short-term time span and you come in and buy here, well, 3 months later, the stock price might be there and now you're losing even more money. This is where you got to, again, understand your strategy and have your parameters in place. I like investing for the long term. So if the stock price is coming down here, I'm going to come in and buy. And then if it comes down here, I'm going to buy more. And if it comes here, I'm going to buy more. So I like to buy in phases. I call this drip investing, where when asset prices start to come down, I start buying. And as they come down more, I buy even more aggressively. There's a couple things that I do to make this happen. Now, before I tell you that, I do got to let you know that investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. But the first thing I got to do is I got to keep some cash on the side ready to invest. And so you got to understand that cash is an investment position. Now, your cash is going to get eaten away by inflation, but I always have some cash ready to invest just in case. The second thing is when it comes to this drip buying schedule, I like to buy in phases. And the way I do that is first, I have my own list of investments that I want to own. So if we're talking about the stock market, I have a list of stocks and ETFs that I want to own. And these are things that I believe in, and I already done this research. Now, if these prices start to come down, that's when I start to buy. And as they go lower, I buy more aggressively. And so this might be every 10 to 15% the stock or ETF goes down. That's when I come in and I buy more aggressively. So I'm paying attention to when these prices come down, and when they do, that's when I buy. The lower they go, the more I buy. Market crashes are kind of like a Black Friday sale for investors because you can come in and buy great assets at a discounted price. The thing that you got to remember is it is impossible. It is impossible to try to perfectly predict when the bottom is. So it's impossible to try to time the market. The people that tried to time the market during the 2020 market crash missed it, and then they saw a lot of people come in and buy, and they missed that rally. And so what you got to remember is it's impossible to try to time the market. And if you do try to time the market, it's like trying to catch a falling knife. And so it's impossible to know how far down it's going to go and how long it's going to take for the market to turn back around. And so if you are investing during this time, you got to have faith, and you got to remember it takes time and patience for things to turn around, because there's no way to predict when this rise is going to happen again. But the reason why you see so many millionaires born during a market crash is because this allows people to come in and buy a ton of assets at a discounted price. And then when things do turn around, now you have these asset owners who see the prices of their assets skyrocket because now the economy is just turning around, and you have these people that are owning huge amounts of shares or assets because they were able to buy at a huge discount. If you enjoyed this video, here's a video on ETFs and index funds that I think you'll love. And while you're at it, join our free finance and business newsletter. And as always, keep hustling. Like if a company makes more money, which is the goal, then the amount of dividend that you're getting will hopefully go up. But if a company starts to struggle, then you could see your dividend go down. Number 2, invest in rental properties.